Your market news now. Asian markets ended the day mixed as minutes from the Federal Reserve's meeting revealed that officials maintained that monetary policy had to be restrictive and had little appetite for rate cuts. Trading volumes in the US are likely to be light because of tomorrow's Thanksgiving holiday. Meanwhile, Avenge CEO Sean Flanagan has announced his retirement and that he will step down in March of next year after more than 5 years at the helm. Scott Cummings, who is the current CEO of Avenge's largest unit, McConnell Dowell, has been appointed to succeed Flanagan. Food producer RFG reported its earnings this morning, showing that despite challenges, it managed to grow its profit. Now, going back to those Fed meetings, what we do know so far is that the Fed says that they need more evidence to know that the inflation figures are coming back to their 2% target. If we go back to 2021, we do remember that the Fed at the time thought that inflation was transitory. They believed that the spike in inflation that we were seeing was as a result of some of the elements we were seeing from the pandemic and the supply chain disruptions. But what it turned out to be towards the latter half of 2021 was that they had to make a U-turn, and that was because inflation was starting to show signs that it was not necessarily pandemic driven, but it was as a result of the increase in demand. And from March 2022, we did see the Fed increase its interest rates at its highest level in 4 decades. However, just to talk to us about the market developments, but also touch on those FOMC minutes, we are joined by Chantal Marks, who is from F&B Wealth and Investment. Chantal, let's get a sense of the market sentiment right now that we have digested those Fed minutes.
Well, the market was quite skittish at first. I mean, we did see the US equity market, for example, come under quite a bit of pressure, and probably a little bit exasperated on the tech side by Nvidia with quite weak guidance going into the next quarter. But this morning, it seems as if things are a little bit calmer. If we look at the stock futures in the US, the prediction is that market will open higher today. On the local side, though, things have been a little bit more circumspect. I mean, if you look at that CPI print that we had earlier today, there's really been quite a substantial reaction to that.
So let's look at the market versus the Fed when it comes to the cuts. Are you buying these cuts going into next year, or you think the market's running a little bit ahead of itself?
I'm still quite a bit nervous around those cuts. I think the market may be running ahead of itself because we still don't know whether or not a recession is going to come, whether or not that recession is going to be deep, or if that recession is going to be relatively soft. I think for the Fed to cut rates, you would actually have to have something that breaks. You would have to have that deep recession, or you would have to have inflation come down quicker than what is currently expected. So I think the March cuts currently being priced in and the May cuts being priced in is probably a little bit on the early side.
Speaking of that, let's talk about those lagged effects of monetary policy. I mean, we're starting to see some signs on the credit side when we look at the US consumer, but are you anticipating more pain to come if we are going to be talking about the idea of something breaking?
So I think on the consumer side, the first place where consumers actually feel Fed rate hikes would be in short-term credit, like credit cards or store credit. And that is certainly starting to filter through. But in the US, most consumers would fix their mortgage rates, which means that the big impact isn't immediately there. But we've now seen that kind of credit card advances have increased. The payments thereof have, or the payment ability, or the ability for consumers to pay down their short-term debt has deteriorated slightly. But yeah, I mean, I'm not sure what exactly is going to happen going forward, and that is why I won't hang my hat on early cuts. I think that we're still going to have a pretty hawkish Fed until, as we mentioned, something breaks or until inflation comes down to target properly.
I mentioned in my intro that RFG, they released their earnings, and a couple of standouts for me, spending about 65.7 million on diesel, but they're also the latest company to show, or rather to flag, some of the impacts that they're seeing when it comes to those local ports. But were there any standouts when you look at those numbers?
I think the standout for me is just how weak demand is locally. So they managed to increase revenue quite nicely in the regional segment, which would include South Africa. But volumes were down by 6.6%. And I think that is something to take note of. So the price increases are coming through, and that's helping them maintain momentum on the revenue line. But demand is really quite weak. And I think that is something that they'll probably take with them into the next reporting period as well.
It's only Wednesday. We've got a couple of more days to go until the end of the week. But however, so far, what's the main story for you when it comes to markets?
Oh, wow. The chaotic move in Sibanye-Stillwater yesterday, I think, really stands out to me. A convertible bond issue is dilutive, but you need to see that in context as well. You are still getting a cash inflow that will fund growth going forward. And the market response was just completely outside of what would have been expected from a similar announcement from perhaps another company. But it highlights how skittish investors are currently, and particularly around the PGM space. I mean, we've had several fund managers flag that they're not convinced over the long-term viability of PGMs and PGM mining. And I think that this convertible bond issue just spooked investors.
Is there a market trend that you believe will continue well into 2024?
So I think in the first 6 months of next year, we're going to have a very similar scenario to what we have right now, where there's going to be uncertainty around inflation and the interest rate trajectory, and question marks over whether or not a US recession will come. And in that kind of environment, you will have quite high volatility, and you will have big outsized moves to small data points. And I think it will still benefit stock pickers into next year. So I'm thinking the next 6 to 8 months is still going to be a stock pickers market, and then maybe things will start shifting towards the second half of next year.
Chantal, let's leave it there. Thank you so much for your time. That is Chantal Marks, who is from FNB Wealth and Investments, giving us her perspective on the markets. And of course, we're going to be looking at the rand in the lead up to that interest rate announcement, which we are expecting to remain unchanged. But the question remains, does it leave the door open for another hike at some point next year, given the uptick that we saw in inflation? However, that is it from me. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.